We will now discuss merchandiser sales. So the merchandiser's interaction with customers. And we're going to be working from Quick Study 4-4. So it says, on April 1st, we the company sold merchandise for $3,000, granting the customer terms of 210. Invoice dated April 1st. The cost of the merchandise is $1,800. So we have to record not only the sales part of the transaction, but the cost portion as well. Okay? So we've recorded that here. The sales portion, since the customer didn't pay immediately, means that we will get cash from the customer, but in the future. So accounts receivable would increase for $3,000, what the customer owes us. We also earned that revenue when we made the sale, so we would increase sales for $3,000. We still have to record the cost portion associated with that sale, so the cost of our merchandise. Cost of goods sold would increase since we sold the merchandise, and merchandise inventory would decrease because we no longer have that inventory in our stock. And it would be for $1,800, which is the cost of the merchandise. Number 4, so April 4th, it says the customer in the April 1st sale returned merchandise and received credit for $600. The merchandise, which had a cost of $360, is returned to inventory. Since the merchandise is in saleable condition, we can return that merchandise to our inventory. So not only are we undoing a portion of the sale, but we have to make sure that we are increasing our inventory again, since it's now a part of inventory. So the first part deals with the sales portion. We have sales, returns, and allowances, and accounts receivable. Accounts receivable would be decreasing for $600 because the customer no longer owes us that money. Sales, returns, and allowances would be increasing. Almost think of that as an expense, even though it's not, but almost think of that as an expense, and that would increase for $600. We then have our cost portion recorded here. Merchandise inventory would increase for $360, and cost of goods sold would decrease for $360, meaning we haven't sold that anymore. We now have to resell it. So the expense cannot be recorded since we haven't technically sold the merchandise again. So merchandise inventory would increase for the merchandise we have back, and cost of goods sold would decrease. On April 11th, it says we received payment for the amount due from the April 1st sale, less the return on April 4th. So on April 11th, that falls within the discount window, so the customer can take a discount on the merchandise. So I've recorded for you here, originally they owed us $3,000. We had to take out the return of $600, which left us with $2,400. That was what was owed to us, okay, which you see reflected here in accounts receivable. However, the customer was able to take a 2% discount. So $2,400 times 2% is $48. The $48 is the sales discount, which you see reflected here, which is almost like an expense. We then take the $2,400, the original amount owed, and subtract the sales discount of $48, and that leaves us with $2,352. That is what the customer pays in cash to us, which is why you see cash reflected as $2,352.